we've got Ramya Suryanarayanan, who's an economist at Group Research at DBS Bank in Singapore. She joins us on the show. Ramya, to begin with, tell us what your outlook post the union budget here in India is. Are you comfortable with the fiscal deficit target of 5.1% of GDP that the finance minister has set? And also, do you think India will be able to achieve this target? What's your view on expenditure and also financing of the fiscal deficit?
Well, the 5.1% of GDP target is a lot more realistic than last year's target. But we still expect quite a substantial slippage in the next fiscal, which is actually quite a counter-consensus view. The receipts, that have been budgeted, revenues that have been budgeted are pretty realistic, even though we think the growth assumptions are still on the optimistic side. But the expenditure that has been budgeted, we think, is not sufficient, especially for subsidies, oil subsidies. And actually, according to our calculations, even the 2011-12 estimates, budget estimates, don't fully account for all the subsidy expenditure that will probably relate to fuel subsidies for that fiscal year. How is that possible? That's possible because oil marketing companies bear the subsidies or under recoveries first, so the government is yet to compensate them for it. So actually, even the 2011-12 deficit, we think, is going to be higher than the acknowledged number.
Afternoon, Ramya. Now, does the government borrowing program look challenging according to you? And what's your outlook on bond yields in the light of the growing inflationary concerns on account of government borrowing and crude oil prices?
Well, we expect a 1% of GDP slippage in the 2012-13, against the target, which would translate to about 1 trillion rupees of additional borrowing in 2012-13. That means net borrowing of 5.8 trillion rupees instead of the 4.8 trillion that has been budgeted. In addition, as I mentioned, since we think 2011-12 deficit actually doesn't fully account for all the subsidy expenditure of that year, there might be additional issuance to account for that. And in fact, there has been, a substantial additional T-bill issuance in 2011-12, about 1 trillion rupees or 1% of GDP, roughly higher than budgeted. That could also, be refinanced by longer-term bonds. So the T-bills could be refinanced by longer-term bonds eventually, which means from a supply perspective, the bond market, it's quite negative. The supply angle is quite negative for the bond market.
Right, and do you think India would be able to achieve a growth level of 7.6% for the next financial year? What are your expectations? And what do you believe the key drivers to GDP growth will be? And again, when do you think a substantial reversal in India's investment growth and industrial growth will actually begin to be witnessed?
Yeah, the budgeted assumption of 7.6% real GDP growth actually means acceleration from 2011-12. Where probably growth was about 6.7 or 6.9%. We think that's actually not going to play out. For one, the fiscal deficit in 2012-13, there will be some consolidation in fiscal spending, so that itself will be a headwind to growth. As we've seen, there are excise duty hikes, and there will be some fuel price hikes also coming up. Those are some examples for why or what might hurt growth from a fiscal perspective. And second, the global growth backdrop also is more worrisome this year, in particular Eurozone, than was the case last year. So from both these perspectives, it appears to us that 2012-13 growth cannot beat the previous year's growth. So our forecast is actually for a further slowdown to 6.5%. But as I said, the revenues that have been budgeted, are not overly optimistic, even though the growth assumption is more optimistic than our forecast. So the slippage, in terms of the slippage, we're still more worried from the expenditure perspective.
And what's your outlook on the rupee? Is there a further downside that you're expecting? And if you could just walk us through what your expectations are for the rupee for FY13.
Oh, yes, absolutely. Well, the rupee, has first appreciated, of course, in Jan and Feb and has then depreciated in March. We think the appreciation in Jan Feb was driven quite a bit by temporary factors, especially substantial central bank intervention. In fact, the central bank's data itself reveals a $7 billion, total of $7 billion of sales. In January, and $7 billion is a huge amount for a month. So that explains, the behavior of the rupee, the appreciation of the rupee in that month. And we also had NRI deposits, non-resident deposit inflows that came in because of, substantial increase in the interest rate offered on that deposit. Now, both these factors are temporary. So, by extension, the appreciation we saw was temporary as well. On the other hand, going forward, we think there are going to be more and more concerns about the fiscal deficit. Like I said, consensus is still expecting that, 2012-13 is realistic, while we think it's not. So, at some point, that's going to come, that's going to create more attention, get more attention, and the ratings, it'll have an impact on the credit ratings as well. So overall, we think the rupee could come under pressure. And most importantly, even though the rupee has weakened quite a bit, compared to last year, on a real basis, that is if you adjust for inflation, actually, the rupee is not really that much weaker than last year on a real basis. So looking at it from many different angles, we think dollar rupee is headed higher. We think maybe 52.5 by June, and in general probably on the wrong side of 50 ahead.
And lastly, Ramya, what are the key global risks that India faces in terms of capital flows and growth? Do you think there would be moderation of flows into India?
Well, yeah. So on the one hand, the problem, that the Indian economy is facing in general, to put it simply, is that demand is running ahead of supply in general, and the other way to look at it is consumption is stronger than it should be, and investment is weaker than it should be. So this means on the one hand we have a widening current account deficit, which, as I said, since I think rupee is not really undervalued, so it's going to weaken further. But that will happen only after we see, the current account deficit is going to widen first and put pressure on the rupee. In the meanwhile, so you have about a 4% of GDP current account deficit, but you're not going to see capital inflows as large as that. So capital inflows are going to be a problem, A, because of the domestic growth worries and fiscal worries, and B, because of the global backdrop too. So India is very much dependent on global capital flows. Liquidity is tight domestically, and the current account deficit is widening, but capital flows could be maybe half as large as the current account deficit, and that's where the rupee depreciation outlook comes from.